Assalamu alaikum and good evening, everyone. My name is Mohammed Tanveer and I am a Vice President of QSAP Riyadh chapter, KSA chapter Riyadh. I am currently working in Qadian Investment as a projects controller. We welcome all the attendees and appreciate their time. QSAP stand, we will explain what is QSAP just for now. So QSAP is Quantity Surveyors Association of Pakistan. We have more than 1,200 members in more than 6 countries all over the world. We have we are non-profit organization and believe in free knowledge sharing. Today is our webinar number 19. This includes series of 9 webinars. Previously, we delivered 9 webinars on FIDIC last year. So this year we have started this series related to public-private partnership. So videos of our all webinar will be available on YouTube, but it will take time, maybe a month or two. It's worth mentioning that all of our events are free of charge and available for audience to gain knowledge. The presentation which our speaker will present us, you can find tomorrow on the LinkedIn page. You can download from there, or if you face any difficulty, you can just mention your email ID and we can share with you. So today we will start webinar number 19. Basically, it's QSAP webinar number 19 and second webinar of this series. So before that, just I want to make one announcement. We will share attendance form in the chat box. You all are requested to fill that attendance form and accordingly, your certificate will be distributed. So please, you have to mention your name and email ID so that you can receive your certificate on the mentioned email ID. And number two announcement is question will be at the end of the session. So please keep writing your question in the chat box. We will try to cover maximum 10 minutes and the remaining will be entertained after the webinars. Now let me introduce our speaker. Speaker is Mr. Abdul Hai. Abdul Hai is working as a design and process manager in the development department of Miyahana, which is one of the leading local water and wastewater developer, investor and operating in Saudi Arabia. He brings about 18 years of diversified experience in water and wastewater treatment sector and wet utilities as a process specialist and project development lead with proven track record of managing techno-commercial aspects. Abdul Hai has successfully delivered various development projects from inception stage to financial closing. Abdul Hai is primarily a civil engineer, holds a master degree in environmental engineer, and is a PMP certified from PMI as well. Today, Abdul Hai will deliver his second lecture related to project development. Abdul Hai Saab, over to you. So please, you can start now. Thank you.
Okay, thank you, Tanveer. I would just like to thank one more time the QSAP Forum for organizing yet another wonderful webinar. And secondly, I will be having my appreciation to all those attendees who have been sparing their time and attending this presentation. I believe that after this presentation, you will be getting much more information and it will be supplemental to what we have done in the past. So, not to spend much of time in our current formalities, let's go to our lecture. So, as we have discussed, that it's basically a three-module series, and each module will comprise of 5 webinars. We have already delivered first of its kind, which was Introduction to Project Finance. And project finance is actually one of the component of the PPP concept. We will recap what we have discussed in the previous webinar in short period of time. Today is lecture number 2. And in lecture number 2, we will be discussing 2 aspects. One is working with lenders. We discussed a lot more about the project company and the sponsors. Today we will talk more about lenders, and at the same time we will discuss about the project development aspects. Upcoming lecture will be discussed. We'll discuss about role of advisors in our upcoming lectures, the process of tender and risk. All of them will be coming. But as of now, we are covering lecture number 2. Before going to the lecture number 2, I will just like to have some recap of webinar number 1 for those who were unable to attend, or just to give you a refresher of that lecture that we have made. Okay, so first of all, we had discussed basics of project finance, and we understood that project finance is an off-balance sheet initiative where lenders normally look at cash flows And the project feasibility primarily depends on the cash flows generated by a project. And those cash flows must be able to cover their operating cost. They must be able to service the debt, and they must be able to pay to the sponsors. We also discussed earlier that project finance is a non-recourse. What does it mean by non-recourse? That sponsors don't normally guarantee the repayment of the debt, and lenders can only retrieve their money from the cash flow of the funded project. So we had discussed this aspect in detail in our previous lecture. Similarly, we discussed about the advantages of going with high leverage. We understood in our previous lecture that debt is always cheaper than equity. So if we are going with more debt, our leverage will improve the return of investor. So higher the leverage, higher the return of investor. This we discussed in our previous lecture. We also discussed that if we get with more lending, the proportion of the lending is higher, the cost of the product goes lower. As well as we also discussed in our previous lecture that why we should use project finance. There were many advantages mentioned in our previous webinar. One of them was that high leverage requires small equity. And once you require small equity, parties with different financial strengths, they can work together. And since a lot of money of lenders is at stake, lenders will have an extensive due diligence process. And this due diligence process mitigates the risks. And project finance going with low equity gives an additional investment opportunities for the sponsors to get more return on investment on the money they have. We also discussed in our previous webinar that what are the typical financing structure. We discussed about the offtake contract. This is a kind of a contract in which a project is a process plant. There is some input and there is some output. And that input is being provided typically either by the sponsors or by the client, but the output is always being taken by an off-taker, which is a government client or private entity, and they pay as per the amount they are taking as an output. We also discussed in our previous webinar the concept of concession, and these concessions, we mentioned that they were mostly applicable to public infrastructure, like roads, like bridges, and similar kind of work where the payment or the cash flow is generated by the tolls and which are termed as user charges. And we also discussed a PFI concept where the cash flow is generated merely by the payment of the government, and the government pays as a means of service fee. We also discussed last time aspects of the project finance, and we understood that sponsors are not the priority and lenders are priority. So if there is any cash flow being generated, after deducting any operating costs, rest of the money should first be used to pay to the lenders, and then the remaining money should be used to pay to the sponsors. So lenders remain priority. We also discussed one of the bottleneck that project finance is a very slow process. The due diligence takes a lot of time, and sponsors sometimes lose control of that because lenders will keep a close eye on the project financing aspects. So this takes time, and sometimes they make frustrating progress for the developer. We also discussed that one of the bottleneck of this project finance is that it restricts the decision making for the sponsors, because the monitoring and control of the activities of the project company is being governed by the lenders. So to control the process, lenders take majority of the time some crucial decision, and this makes sponsors on the back foot. So all these concepts were discussed in greater detail, and If you want to get some more insight, you can refer back to the presentation that we had delivered earlier. And as I believe that QSAP forum will be uploading these videos after some time, so you will also be able to refresh your mind with lecture number 1. So this was all a recap of our webinar number 1. We discussed all these aspects. Now we will go to our main content of webinar number 2. And the principal title of this presentation today is Working with Lenders. We will talk about the source of debt funding. We have discussed more about who will be the sponsors in the previous lecture. Today we will talk about who will be the lenders. And then we will discuss different aspects of lending. And slowly we'll come across the development. What is the project development? And what are the typical agreements made among the sponsors and the development companies, and what are typical their teams. So we will come up with our first question, which was partly answered in our previous lecture. And that question was, who are the sponsors and who can be the lenders? So sponsors, we discussed previously that they can be the EPC contractors, they can be the O&M contractors, they can be the public parties, they can be financial institutions, and they can be industrial companies whose aim is to get a return on their investment. So they become a sponsor for the project. Now we are going to answer the second part of the question, who can be the lender? Or in other terms, what are the typical sources of debt funding? If we look at the typical sources of debt funding, there could be many, but I will be talking about the most commonly used sources of loan that could be obtained for project finance or a PPP project. So one of the major source that we can think of is a commercial bank. And this commercial bank, you can think this commercial bank of a normal bank that we are engaged with in our daily lives. So these are the banks who are accepting the money from us, and they are the banks who are giving money to us, and they are the banks who are running the accounts, and they are the banks who are dealing with the daily life of the projects. So these are one of the commercial banks. So one of the source of the funding can be a commercial bank. The second source of funding are development banks. Now we need to understand the difference between the commercial bank and the development banks. Unlike commercial banks, development banks typically don't deal with the public. So they do not have their branches open in multiple regions of the city, multiple areas of the country, but rather their aim is specific. So their aim is to develop the country's economic growth, and they are the one whose mandate is to ensure that whatever are the projects being made, they are meant for the economic growth of the country and the community. So their projects, they fund to only those projects which are aimed at public progress or public benefit. So these development banks are being made in the region by member countries. For example, we in Pakistan have been working with Asian Development Bank. So majority of the countries which are in Asia, they are member of this Asian Development Bank, and they contribute some money to these development banks. On top of that, these development banks earn their money by lending on projects, and these development banks are financing projects which are mostly of governmental nature, and typically they work with the government. So development banks' mandate is solely to improve the financial or economical conditions of the country, and they normally deal with the governments They typically don't deal with the private sponsors. Another source of financing or debt funding is Export Credit Agency. Now, as you can see from the heading, Export Credit Agency. So these are government-backed institutions which aim to improve the export of that country. For example, if I, as a sponsor, want to buy some equipment or some machine or some heavy duty items from a country, there are some banks of that country that could offer financing to, to allow me buying that product. So what is the intention of Export Credit Agency is to promote the export of that country. So many countries, they have their government-backed institutions who can fund to those projects or who can fund to those equipment which are being procured from their country. So the intention of funding is to improve the export of that country. So we have different sources of funding. We have commercial banks, we have development banks, and we have export credit agencies who can fund. In most of the cases, commercial banks are the one who finance most of the projects. So they are the largest source of funding, and they are most experienced in terms of debt financing. And this will be our major focus in our upcoming lectures and throughout our modules, that we will discuss mostly a source of funding as a source of fund given by commercial banks. Now, if I'm a sponsor, so my priority should be that I have to raise a fund from a commercial bank. So my first preference would be that I would raise my finance from the bank of that country in which that project is working. What is the reason of this particular interest of working with that bank, commercial bank, and the country where the project is being implemented? Because if I will go to the local banks, they will have the best understanding of the local conditions. And one more important thing is that the funding the banks can provide will be in the local currency of that country. So I, being a sponsor, will avoid the risk of foreign exchange. And as you can see, this could be a problematic area in developing countries, which are like Pakistan. In Pakistan, there are no local banks who would be willing to give the finance on long-term basis for a project because they are not very much experienced in this kind of project finance, as well as there is no market for long-term loans in domestic banking market. So I, as a sponsor of a developing country, would like to go to a foreign country and would seek the funding from that foreign country. But one of the greatest problem that I will face being launching my project in a developing country is the foreign currency exchange risk. We have seen in recent times that the currencies in the developing countries has depreciated to great extent. And if I bring some foreign bank, they would like to make the funding in hard currency, which is not going to fluctuate. So they will typically deal with in dollars, and they will typically deal in any other hard currencies, which they feel they will have more security on that. So if I will ensure my fund based on a foreign currency, I would be at greater risk because after 1 year or 2 or 3, my currency will be depreciated, and I have to pay still the same amount of dollars to that company, to that commercial bank, and as a result, I have to pay more that I was expecting to pay in our initial stage, and this will have a negative impact on the economic growth of the country because whatever we are paying is much more than we envisaged initial stage of time. So this is one of the risks. So if I'm a sponsor, my first preference will be to finance from a commercial bank that is of the similar country in which the project is being launched. But there are sometimes no choices. You have to take this decision, and that's why in Pakistan it's not easy to fund the project on finance basis because of the currency exchange risk, and this is one of the biggest risks that we have been suffering from almost 2 years because of the depreciation of the country. Now, one thing, sometimes commercial banks, they have their own limitations. They have a ticket size, which means that they specify that they will not give a loan beyond a certain value. And once we have large scale projects, the amount of fund required would not be provided by one bank because they don't want to take a bigger risk. So what they do, in that case, few more banks come in and they make a club. And this club combines all these banks to fund the amount of money that is required for a project. So when there are large loans, banks often form syndicate with the primary aim to sell down their interest and to reduce their risk. Now the question is, the project company would not be willing to work with many financial institutions or commercial banks because this will consume a lot of time to work with individual banks. So what they do, typically the project company would be willing that one out of these banks become a lead bank, a lead arranger, and it acts as an agent for that group of banks, and project company will only deal with that bank, and this bank, which is the lead bank or the agent bank, will facilitate the overall process against some fees that project company will pay. So what happens in that case? So in case of more than one commercial bank forming a syndicate, one of the bank becomes an agent bank, and the role of that agent bank is to act as a communication channel between the project company and the banks. So this agent bank has a major role in collecting the funds from multiple banks to ensure that if there is any drawdown of money is required, that money drawdown is made, and that agent bank, after collecting the money from all the member banks, gives it to the project company to start construction. This agent bank, on behalf of the other banks, holds the security of the project. And as we discussed previously, holding the security means that there are many documents, contractual documents, that part a form of the security of the project contract, PPA. We will discuss it at some later modules. What are those securities that a lender would like to have? So all these securities documents are being kept by that agent bank on behalf of other banks, and he forms a security trustee. And the security trustee holds all these on behalf of the banks, and this is being controlled by the agent bank. Now, this agent bank calculates all the interest rates. What are the interest payments to be made? What are the principal amounts to be repaid to the banks? So all these calculations are being done by this agent bank. So if there is any money being received from the project company, So this bank collects the money from the project company and passes the respective amount or proportion to the relevant banks. And this agent bank monitors product company's compliance, whether this product company is complying with the financing document or not. And if there are any anomalies or any deviations, this agent bank inform syndicate banks. So all this is coming against a certain fee that has to be paid to this agent bank. And this makes the life of the project company much easier because the project company in future, during a tenure of 20 or 25 years, will not have the hassle of communicating with so many banks and rather will focus on one agent bank who will act on behalf of the lenders and who will communicate with each and everything. So commercial banks are the sources of lending. Development banks can be sources of lending. ECAs, which are export credit agencies, can be source of lending. Out of those, commercial banks are most commonly used, and we will focus much more on them in our future presentations. And whenever there are more than one banks, there must be some syndication, and one of the bank must be nominated as an agent bank to facilitate all the processes that will be held between the product company and the banks. Now, we discussed about banks as one type of funding. There is another source of funding, which are actually bonds, a project bond. This is an alternative to the financing that project company can use and can obtain funding by issuing bonds. So what happens? The project company issues bonds, and these bonds are issued with a commitment that there will be a periodic payment of coupons. And once the capital they have obtained from issuing the bonds will be returned at maturity of the project. So project bonds are issued at a fixed amount of money that will be paid regularly to the bondholders. And once the tenure of the bond is matured or is finished, all that amount of money will be returned back. So this is another type of financing that banks, that the project company would be looking at. So what are these bonds? One of the difference between the loans of commercial bank and the money obtained through bonds is that the bonds are a tradable item. So once the bonds are issued, they becomes a tradable instrument, and they can switch from one hand to another hand. And this amount of money remains with the project company, but these bonds can be traded among the parties who had not purchased it earlier and who wanted to purchase it later. So this is one of the difference. And one more advantage is that the bonds can be purchased by much wider number of parties. What are those parties that can purchase the bond issued by the project company? Typically, these bonds can be purchased by commercial banks. Commercial banks can also purchase by bonds can also be purchased by commercial banks. Okay, there are many institutions like pension funds, like life insurance companies, like mutual funds, investment funds. They have the money and they have their commitment to their clients that they want to pay back to their clients. So what they look for opportunities of investing in those areas where risk is low and they are able to get their money back. So these funds, they have a lot of money. So they look for the sources of this money to be injected somewhere. And in turn, they look for a long-term fixed rate in turn. So in the form of the bonds, this gives an assurity to those insurance companies or pension funds that if they will invest in those bonds and they will buy those bonds, the project company will pay them a fixed amount of coupon on a regular interval, and which will enable them to pay these money back to their clients. But the problem here, the bondholders who purchased the bond, they have to make an investment decision whether to buy these bonds of that specific product company or not. So what they do, they primarily look at the risk involved in the procurement of a specific bond. So the level of risk that is involved in procurement of the bond to ensure the money is not lost in future, this is one of their key concerns. And these investors, like pension funds, like life insurance companies, they don't go into the lot of due diligence processes like banks will do. So what happens in this case? Project company hires an investment bank. So the process I will explain a bit. Project company hires an investment bank. This investment bank does not give the money, but rather facilitates the process. And what that process is, that project company, which is a special purpose vehicle, appoints an investment bank, and that investment bank's role is to assist in structuring the project. And what this investment bank makes? This investment bank makes a presentation on the project to a credit rating agency. Now you should understand some catchwords. In bonds, there is typically an investment bank being hired by a project company, and that investment bank looks on the different aspects of the projects and risks and makes a presentation to the credit rating agency. These credit rating agency, the famous ones are Moody's Investor Services. They are Standard and Poor. These are the rating agencies. So once that investment banks makes the presentation of that project to credit agency, this agency assigns a rating to that project or that bond. This credit rating can be A plus or B plus or B, whatever is that. Once this rating is given by the credit agency, this is given in view of the risks of the project. If the risks are high, the credit agency will not give a high grade to that bond or to that project, and this will go to the prospective bondholders. And some of the companies like insurance funds, like pension funds, they have their own policies that they will not invest in any project which has a credit rating less than this. So once this credit rating is established by the credit rating agency, then those investment banks issue a prospectus to the potential bondholders with the aim to test the market. And they see what is the interest of the potential investors in bonds and whether they want to buy it or not. So after the credit rating agency makes a credit rating for the bond, they make a prospectus. It contains all the details, and then they go to the market, pension funds, life insurance companies, and they advise them to buy these bonds. And these companies, based on their policies, whether to buy A plus or B plus or C plus bonds, they decide to buy and they show their interest in the procurement of these bonds. And once they test the market and they get typical interest from multiple interesting parties, they issue the final bond prospectus and then they sign and then they guarantee the bond through a subscription agreement. So by this way, the funds, they buy those bonds and they give the money to the investment banks, and that money is given to the project company, and then the project company will invest in the project to construct. So this is another tool that is being used by some project companies to raise money to source their project. Now, one of the key aspects of the bonds is that the bondholders would like to have the least risk so that they can buy the bonds and they will not face a problem in future. So here we will go with some differences or some comparison between bank loans and bonds. One of the thing in the getting the bank loans for financing the project is that all the contracts are very confidential. So these contracts, whether they are EPC contract, the O&M contract, the offtake contract, they cannot be disclosed. And if the project goes into difficulty, to solve those problems, any negotiation should remain private. However, on the contrary, in terms of bonds, the investment bank has to publish a bond prospectus. And in this bond prospectus, this investment bank has to declare many details, which will be used by the bondholders, prospective bondholders, to decide whether they should buy the bonds or not. And there could be some crucial agreements which will be publicized, and sponsors may not want these to be disclosed for business and commercial confidential reasons. So in bonds, you have to show up with all your contracts to the market, to the bondholders. But in case of the loans, any things remain confidential and they remain among the concerned parties. One of the things in terms of bank loans is that banks are involved in the early stage of the project. So if there are any concerns of the bank on the bankability of the project, banks give their input, and the sponsors and their advisors, they resolve the issues to make the project bankable and to ensure that the bank loans are being issued. On the other hand, for bondholders, these bondholders come at the late stage of the project. Why? Because sponsors have to run a process of hiring an investment bank, and then this investment bank will go to a rating agency, and then this rating agency will give a credit rating and will decide the price of the bond, and then the bondholders will be engaged by this. So bondholders come at the end of the stage, while banks are engaged in the very early stage, and this helps to the project finance because sponsors will get positive feedback from the banks, and if there are any difficulties, they resolve it. But in case of the bondholders, they don't have appetite to buy the bonds, and they feel that the risks of the project or the rating is very low, and if they do not buy, it makes a problem for sponsors to get their money and start the construction. And another thing in terms of the bank loans is that more accurate financial forecasts can be prepared from the start. Because what happens once the sponsors, they start the process of obtaining loans from the bank, typically they want to know the terms and conditions on which the bank is willing to lend the money. So they typically come to know the potential interest rate, potential margin that banks are going to charge. So they have some idea of the amount of interest or the margins that banks are going to get. Although this is not formal, and once they have a financial close, they get their commitment again, but at least sponsors have some visibility that what could be the cost of financial project. However, in case of bonds, the appetite of the market will only be known at the late stage of the process. So the price, what should be the final price of the project, is only known at the later stage, because the bondholders come at late stage, and based on their appetite, the price of the bond is established, and then the sponsors come to know that what should be the final price of the project. Similarly, in terms of bank loans, the funds are drawn when needed. Take an example of a construction period which spans over 3 years. So what happens, that banks commit to fund the project on a span of 3 years, but they will release the money only based on certain agreed curve, which is typically called an S curve, which indicates that when the project amount will be issued based on the progress. On the other hand, in the bonds case, you issue the prospectus and bondholders buy, and all the money is received at one time. And then what you will do of that money? You don't need that money now, and you need that money over the span of 3 years. So most of the time, project companies, what they do, they reinvest the proceeds that they obtained as a result of issuing the bonds. Now, here is a problem. And the problem is that they have an X amount of money to be consumed and Y amount of money to be retained. So the amount of the money that has to be retained, they cannot keep it without getting any benefit from that. So they may redeposit it in some bank to get some interest. But in the same time, they have to pay a fixed amount of money to their bondholders. So the amount of money during the construction period, which they are going to get from the bank, could be lower than the amount of the coupon that they have to pay to their bondholders. So this is an issue which remains some matter of concern in case of bondholders. And in bank loans, the fixed rates, the interest rates are only fixed through hedging arrangements. In bonds, they are always fixed, irrespective of what is the earning of the project. The bondholders must be paid a fixed coupon on a regular interval. In case of bank loans, the banks control any new debt. If the project needs some expansion, banks can give a new debt to the project company to expand their project. But for the bond cases, if a project is to be added, then they have to really agree on the financial terms in advance by issuing the variation bonds. So these are some of the concerns or the comparison between ensuring the financing through bonds or through bank loans. What is happening now, that the concept of the bonds is not very famous because of the risks involved in getting those bonds. And typically, because of the risks, bondholders would not very easily buy those bonds, and project company may have difficulty of raising the money. So most of the time, the commercial banks are engaged, and the sources of the loan are through bank loans, and that money is being used. So most of the time in future, whenever we will discuss about lending, we will discuss about commercial banks, and we will discuss about project loans obtained through banks. Now, commercial banks, most of these commercial banks, they have specialized departments which work on PPP. And these specialized departments are available in many regions of the country. And these departments, sometimes they have more than 25 people. And those 25 people look at various aspects of the project financing. So what are those people in the financing department? They are mainly professionals with banking or finance backgrounds. And these people are, although not very expert in other areas, but because they are working in a specialized department, and every now and then they work on variety of transactions, they develop experience and expertise in various industries, and that's why they become very expensive, because they get specialized, they get expensive, and the banks have to pay a lot of money to these specialized team members. So normally, whenever they finance the project, they want to see whether the money which they are spending on the team, on the specialized department, is being recovered or not. So they will not finance a project which is of low value, because this will not recover or generate enough revenue to make the time they are spending on the financing worthwhile. So you need to understand, a project with a low value is most likely not to be financed by the banks. I just give you an example. For example, if you talk about a project with the financing amount of $25 million, is unlikely to be financed because it is uneconomic for them. On the other hand, if it comes to $100 million, the banks will look into this because they were able to generate enough revenue from this project. Now, I'm as a sponsor, I have a project, and I know that I want to get the finance from a commercial bank. So what is my approach? What is the first thing I have to do? The first thing I have to do is to engage a bank who can give me the loan. So in order to arrange a project finance loan in the PPP is to appoint a bank, which is a commercial bank, who will be underwriting the debt. Underwriting means the guaranteeing or signing the debt as the lead arranger. So that bank which ensures or guarantees to give me the loan is called lead arranger, and my first priority once I have a project is to appoint that bank. Now these banks are living in their own world. They will not know what my project is, and they are not familiar what I'm going to do with that project. I am the one who has to approach those banks and to give them the pertinent features of my project. So I, as a sponsor, have two ways to do it. I would hire a financial advisor, and this financial advisor on my behalf will issue a preliminary information memorandum. And this preliminary information memorandum, or you can call it sometime project teaser, this project teaser or information memorandum is presented to the multiple banks. And this information memorandum contains all the key elements of the deal for them to understand and digest. So if the sponsors are experienced enough, they can directly communicate with the banks. But if they are not experienced enough, or most of the time they do not want to take the risk of losing, they will typically hire a financial advisor who will issue a project teaser. And this project teaser will go to the bank, and the bank will review all the details and then will give a kind of intent whether they want to be in a lead arranger for this and underwrite the loan or not. So sometimes it happens that this project finance, the team of the bank is a project finance team. We as a sponsor present the memorandum to them, and then there's another team which approves the credit. So the project finance team is the team who is looking at the project finance aspects, but the credit approval team is a team who is willing to approve the credit. And there is a potential risk that the financial team of the bank will approve that they are going to approve this, and later the credit approval team does not give the approval and the project goes in mess. So typically what happens that once the project memorandum is issued by the sponsor, the financial advisors, this financial team communicates with the credit team and they give an initial investment proposal, initial investment approval. And this initial investment approval gives a kind of relief that once any peculiarities of finance are being dealt with, the credit team is going to approve it. So what they do is that they they issue an investment approval, and based on an investment approval, there is a letter of intention. This letter of intention gives a comfort to the sponsors that banks are interested and they have appetite to go with this finance. Now, what includes in this information memorandum? Actually, this information memorandum, which sponsors or their advisors prepare, it gives a synopsis or a summary of the structure of the project and how it is going to work. So what are the typical details that are given in that information memorandum? So first thing, the overall overview of the project. What is the background of the project? Why this is going to be constructed is mentioned in this memorandum. There are some financial information of the sponsors. Who are the sponsors? What are their balance sheets? Who are the project parties? What are their experiences in conducting similar projects and involvement is also given. Some structure of the new project company, how a project company will be made, what will be the typical format of the project company, who will own it, what will be the organization of the project company, and who will manage it is defined there. Okay, some technical description of the construction and operation of the project is also given. So what is the technology being used? Who is the contractor? In which time it will be constructed? It all is mentioned in a very brief format to the information memorandum. Also, there are many other things that are given to them. For example, if there are any contracts that are going to be made and they are available in the draft form, their summaries are shared with project banks so that those banks can understand the risks involved and they can look at them and they can give their comments. What are the project costs? How the financing will be done? How much amount of equity sponsors are planning to inject? What amount of debt they are planning to get is also mentioned in this information memorandum. The financial analysis is made. The financial analysis means that banks would like to see the cash flows, how the cash flows will be generated, how much amount of cash will be generated on regular intervals, so that they can decide the lending. And also some kind of sensitivity analysis is also shared with them. For example, what if the revenues goes high or low, how it will impact the cash flow. Also, if the cost of the construction goes high, what will be the impact, how it will impact the cash flow. If the O&M cost goes high, what will be the impact? So all these sensitivity analysis is also given to them for them to make a decision whether they want to lend for this project or not. And this is where the bankability term is used. If the bank, looking at the information memorandum or looking at the contracts or looking at the financing or sensitivity, believes that this project is not going to be financed, that project is typically termed as not bankable project. So in order to make it bankable, all these changes have to be made, and to ensure that banks are satisfied with all these sensitivities, financial analysis, financing plans, this is one of the crucial terms. So in case project memorandum is issued to the banks and banks look at this and they are quite happy to lend this money, they normally issue a letter of intent. And this letter of intent is provided to the project sponsors to confirm that they are interested in getting involved in the project. But this LOI should not be considered any legal commitment. This is not a legal commitment, but a comfort given by the banks. Sometimes the banks, they give their letter of intent on conditional basis that they are willing to invest in a project provided that they are the exclusive bank to be a lead arranger for this project. Or in some cases, if we have contacted multiple banks and we agreed with them the terms and conditions, few of these banks would need to be given an exclusivity confirmation through a mandate letter, which specifies that in case if the project moves on, then they will be completely nominated as a lead arranger or the commercial bank who will giving the loan for this project. Now, letter of intent is received from the bank. The bank is willing to provide the loan. The terms of the loan, the conditions of that loan must be documented in a document. And this document should form the basis of the finance. And what that document is called in the early stages of the project is a term sheet. So this financial term sheet is being agreed between the commercial banks as well as the sponsors, which act as a guideline for getting the loan and agreeing on the finances, financial documents at the later stages of the project. So now what does it include? So in the term sheet, a summary of the main commercial and financial terms is mentioned. And what are those terms? For example, what amount of loan sponsors are willing to get from the bank? And for how much period of time this loan must be made available by the banks and remain available for the sponsor? What are the interest bases and the margins that a bank is willing to take on this transaction? And as you will see in our upcoming webinars, there are many fees to be paid to the banks. Arrangement fees, because one of the lead bank, agent bank is there, he's doing a lot of arrangements. He will demand some fees. The money is to be there for a certain period of time. So there is a commitment fees. There are some security agencies who are involved to hold the securities. They will have some fees. So all these fees on a high level, they are also agreed in the term sheet that sponsors are going to pay this amount of money on regular basis or intermediate basis to that loan giving bank. Similarly, there are multiple ratios being defined this, that what should be debt to equity ratio, what amount of debt has to be given by the bank, and what equity sponsors are willing to inject. There are many cover ratios that we will discuss in our upcoming lectures. These cover ratios are defined. Any risks which are fluctuating risks, they need to be controlled through hedging. So some hedging is defined. So these things are defined, and how this money will be removed or taken during the construction period, which is drawdown, the procedures are defined. What kind of accounts will be established? What are the procedures? So all of these things are defined on a higher level in that term sheet. So this term sheet basically provides a basis of the project finance team, bank's finance team, to complete their internal creditor proposal. We discussed previously, typically the bank's finance department, they comprise of two different teams. One team is a bank's project finance team, who is primarily communicating with the sponsors to complete all these term sheets and agree on all these terms which we have discussed just now, and then prepares all the necessary proposals and documentation to present it to their credit department. And this credit department ultimately receives this and reviews this to give a formal commitment for approval. So once the project finance team presents the term sheet, agreed term sheet, to their credit approval committee, and the credit approval is given, the next step is to underwrite the debt. What this typical underwriting means, by signing the term sheet, giving a sort of confirmation or flexibility to the sponsors that if they are moving ahead with that project, so the terms of the finances are pretty much agreed. But one thing which is very important, you need to understand, even the term sheet, even the letter of intent, all of this, they are not more than a moral obligation on the side of banks. Because all these commitments are made on a very high level in the early stage of the project. And if the project moves ahead, the banks will engage their teams, their advisors to make a lot of due diligence. And during this course, they may try to change or they may demand to change many conditions, depending on the risk of the project. But we should not see this as a big threat, because once we have a signed term sheet or an underwritten agreed term sheet, banks normally don't walk out from that. So this is a greater chance that once you agree a term sheet with the bank, there is a high likelihood that banks will stand by this agreed term sheet and will take it seriously. So as of now, we have discussed more on the financial terms. What are lenders? What are their typical types? What they need? What is a term sheet, financial term sheet? What is the comparison of bonds and bank loans and all of this? So we have covered, and another question that answers some discussion on the lenders. Now we are coming back to the project deal. So what is a PPP and how it covers its life? So if I will divide a project in a PPP model, it has basically three phases. The first phase, which is very important and crucial phase, is the development phase. And I'm working in the development department of Miahana. And this is the most crucial phase to ensure that the project is successfully developed. And this is where most of the efforts are made by the developers to ensure that the project successfully is developed and is moving ahead for the construction phase. So the second phase after the development is the construction, and the third phase is operation. Now, what is the development phase? There is a term called financial close. And once we say that the project has achieved the financial close, it means the development phase is over. But achieving a financial close is not a simple task, and it needs a lot of coordinated activities. So development phase is the period from the inception of the project to the time when the money is made available to the project company to start construction. So this is a period during which the project is conceived, contracts are signed, they come into effect, sponsors, they inject money into the company, lenders, they inject money into the company, and the project company is authorized to use that finance facility and is willing to issue this money for drawdown to start construction. So this phase is called a development phase. And this phase is the very critical phase. And this takes a lot of time, a lot of due diligence, a lot of work is to be done. And there are many conditions which need to be satisfied to ensure that a financial close is achieved. And this is a complex process, and it can easily run for a longer period of time. It can be as long as 1 year, and it can even extend to that. But most of the time, the sponsors try to control the overall process for a period of 6 to 8 months. And sometimes, if they are lucky, they can even get it done in a lower span of time. Now, the second phase is the construction phase in PPP. This is the phase where the finance, which is arranged by the sponsors and the lenders, is drawn. The project is built, and the project is tested and commissioned and is ready for operating and generating the cash. So once the project is constructed and ready to generate the cash, this process is complete, and the end of this process or this area is called project commercial operation date. So once the project is constructed and it passes through many tests that we will discuss in our upcoming modules, the project is referred to be completed, and this is termed as project completion operation date. So COD or PCOD is the term used at operation when the operation is starting. The third phase is the operating phase, and this is the period during which project is operating and producing the cash flows, and using these cash flows, it recovers the operating cost, it pays to the lenders, and it also gives return on the investor's equity. So these are the three phases which are used in any PPP, and the most crucial part is the development part, and achieving a financial close is a Herculean task, and this needs a lot of coordinated effort among multiple teams. Now, somebody had asked a question in the past that what is the role of the sponsors? Now, as we see, the role of the banks is to give the money, but to ensure that that money is being given, banks, they require a lot of things to ensure the risks are being reduced, mitigated, securities are in place. So to ensure that the money is being received from the banks, there is a lot of activities that need to be done. And it involves multiple parties. We will soon discuss about these parties. These are multiple parties coming to this to resolve many issues banks would have, and they are having unrelated disciplines. Someone is a legal, someone is financial, someone is technical, someone is related to the insurance, someone is related to the environment. All of them, they have unrelated disciplines, and they are not aware of others' work. So what happens? Somebody has to steer the process, and somebody has to integrate all the requirements of the lenders, and somebody has to ensure that the requirements of the lenders are properly communicated to multiple parties, and the inputs are being obtained from them, and they have been synchronized in a way that lenders are satisfied. And so the complex task of coordination and managing the process is normally taken by sponsors. So sponsors typically take the role of steering the overall process to achieve a financial close, and then achieve a commercial operation date, and then ensure that the money is being retrieved during operation and is returned back to the relevant parties. Now, we will talk about different type of sponsors. One of them are those sponsors who work relentlessly on a project, who bring an idea, or who are the one who actively engage with the lenders and clients, and they promote the project and they develop the project and then they manage the project. So they are typically termed as primary investors or active investors or promoters. So you will hear multiple terms of them, but there are some other investors who don't want to get into the hassle of getting the money and being engaged with multiple clients and parties. Their interest is only to invest money, invest equity, and get return. So they don't want to engage in the process of forming the product company, this and that. So those investments are termed as passive investment. So who are these passive investors? They can be investment funds, they can be insurance companies, they can be pension funds, contracting authorities. So they just want to inject an equity and they don't want to control or manage the operations in the process. So they're called passive investor. Now we have seen one thing in the bonds. Most of the bondholders are these funds and insurance companies and pension funds. Once the project is executed, so the risks are mitigated, the project starts operation and starts generating cash flow, the risks are well defined and mitigated, and the overall project picture is very clear. So this is the time when these funds and these insurance companies, they will have the most interest to inject their money. So sometimes sponsors, we will discuss the concept of refinancing and how refinancing is done to improve the project revenues or to make them more competitive. We'll discuss it later. But this refinancing is typically done at the end of the construction or during the operation period. And these are majority of the companies who want to be acting as a passive investor. Sometimes if the equity is small, even these can come and be a sleeping partner and just inject the money and get their return on the equity in some cases. So in large projects, the sponsors will primarily comprise of active and passive investors. And we will see, okay. But one thing is this, we have to see from the angle of lenders. Lenders normally want the original sponsors or the active investors to stay in the project for a certain period of time. Because there could be a potential chance that once the project is constructed, they inject passive investors, they sell their shares to these passive investors and they get out and they make money. So what lenders normally specify that the active investors cannot leave the project until a certain number of years the project has been operational. This could be 5 years, this could be 7 years, this could be 3 years. These are typically required by the sponsors. So if active investors, they typically invest at the financial close or before the financial close and they inject their money. But the passive investor, they tend to come at the later stage of the project and they want to buy shares of the company. And instead of joining the original sponsors, they would like to buy the shares and become passive investors because they do not want to take the risk of the bid. The development cost risks do not want to take, rather they are ready to pay some premium and buy some shares at some premium cost rather than getting involved in the overall process of bid development. And if the project is gone, they are lost. They have lost their money, so they do not go into this. But at the same time, they are willing to pay some premium on the shares, which is offering some incentive to active investors to sell some of their shares and get them engaged and reduce their risk as well. Now, when there is an engagement between multiple equity providers, large projects, we heard, we can bring more than one sponsor. So there can be 2 or 3 sponsors of a project who want to invest their equity in the project company. In that case, the rights of each sponsor must be documented. Just like the financial term sheet, the sponsors must have an agreement that is called development agreement. And this development agreement is made between several sponsors who are interested to split the overall equity required for that project. But the problem in this, the more are the members, the more is complex to have a joint development agreement and is more to have an issue to define the roles and responsibilities. So the joint development agreement will help to solve some of these issues. But one thing you need to understand, because we heard that having more partners is problematic. So sometimes even the development of the project goes on hold, not because the lenders, they have problem in raising the money, but the sponsors do not agree on the issues among themselves. So it's very crucial that at the beginning of the development phase, all those parties who are interested to work as a joint venture and they want to inject the equity as an investor, they agree on certain terms and they define it and sign it in the form of a joint development agreement. So what does it cover in principle? This joint development agreement covers the scope of the project, what is the equity contribution coming from each and every partner. If some of the partner is an EPC company or some of the partner is an O&M company, they would like to take that portion to get more money out of this project. So there are certain exclusivities they would be looking for in terms of the EPC construction to be given to them, in terms of the O&M operation to be given to them. So the JDA covers this aspect, that who will be an exclusive EPC partner and who will be an exclusive O&M partner. Similarly, they define that what should be the development team, because once the project is constructed, somebody has to supervise it. So there could be a development team. So they define that in this development team, how many professionals will be hired by a certain sponsor, how many professionals will be hired by another sponsor, what could be the organization chart, what are the responsibilities of this. And since a series of advisors would be required, so they distribute the role of hiring the advisory services. Who is going to hire a different type of advisor is also agreed among the sponsors. If there are any issues, what are the rules of decision making? For example, if a sponsor, one of the sponsor is also an EPC contractor, and if there is a decision making with respect to the EPC contractor, this could be an issue. So they define the rules of a decision making, that in such case, when the problem happens, how the decisions are going to be made, and what are the budgets that needs to be arranged, and what are the operational costs of the project development team. All of these things, if there's any cost overrun, in what portion the sponsors will inject the additional equity, if there is any dispute, how this dispute will be resolved. So all these matters are being discussed and agreed in the early stage of the project using a formal document which is called joint development agreement. And this joint development agreement, once the project reaches to the financial close and the project company is made, this this joint development agreement is normally converted into shareholder agreement. We will discuss shortly on the concept of shareholder agreement. Now, once the joint development agreement is made, the process of developing the project to ensure that the development phase reaches to the financial close starts. And there are a lot of disciplines required to successfully steer the process. So sponsors require a development team, a very comprehensive, experienced, skillful development team who comprise of different disciplines depending on the nature of the work. And this team could be divided in multiple sections or departments. So sponsors would need to have the technical expertise with them. They need to have the O&M expertise with them to ensure that the project is operated. In order to have any legal contracts among the parties, EPC, O&M, between the offtake contract between the client and banks and direct agreements, they need the advices of legal guys. So they must have some legal representation in their team. Because all of this is a financial structuring, they must have some sound financial guys who would be able to understand the financial models, who would be able to communicate with the banks, and who will be able to communicate with all the external financial advisors. And at the same time, they must need to have an accounting and tax. Now, to have this development, you need a lot of expertise. So there are mixture of disciplines. And one of the risks is that if they are not well coordinated, the project development phase is going to take too long. So one important thing is that the team of a sponsor, which is a development team, must be well coordinated. So either it should be experienced, it should be well coordinated, or if sponsors are not having these in-house expertise, they can hire the services of external advisors, which can be more expensive than having their own team at some time. So what the role of the development team? The role of the development team is that every aspect, every discipline is synchronized, and this leads a coordinated effort to have a financial close. So if they are not synchronized and they are not well coordinated and they do not understand the needs of each discipline having an impact on the other discipline, there is a likelihood that the project is not going to proceed. I can give you one example or an error that can happen. That, for example, project has a legal team, and that legal team agrees on many project contracts. And that makes commercially a sound approach. So they have legally managed it, they have secured it very commercially, but they are not being acceptable from the project finance of view. So if one party is not accepting it from the project finance point of view, there's a likelihood this is not going to move. How you see this? For example, a construction contract, we secure it at low price. But once we are communicating the contract with the APC contractor, we are not imposing enough penalties, and these penalties are not enough, and banks, they think that there is a potential risk in that, they reject to lend for this project. So although the construction contract is very lucrative, but because the penalties are not up to the requirement of the lenders, it's going to be not processed. Similarly, for example, if we have a contract for a fuel, but this contract has been secured for a shorter period of time, and your contract is operate the plant for a period of 25 years, and the contract of fuel is just for 5 years, banks will again see this as a potential risk. And since there is no assurance for the remaining 20 years, the banks are not going to give money. So every aspect of the deal is integrated, and if there is any lacking in one department or one side, the process is going to delay, there will be hiccups, and the chances are that lenders are not going to inject their money. So that's why the development team needs to be coordinated, needs to be experienced, and they need to be well equipped with certain knowledge of other aspects. Even the technical guy is there, he must be familiar with the legal concepts, financial concepts. So whenever there are some discussions, he must know that what technically is going to impact the finance and what financial constraints are going to impact the technical. So it needs a mix of knowledge, and that guy is not easy to find. And that's why the project teams in a development company, they are specialized departments, and they are not easy to be replaced, and they are not easy to be hired. So one thing is this: if there are so much diversification required in the development team of a sponsor, so high costs are to be unavoidable. So definitely it will have high cost, because the sponsors, the development team and their advisors, they work for a long period of time, because we have learned that project finance on a PPP concept is a very slow process, and it can take a lot of time, and there are a lot of teams engaged, so the costs are high. On top of that, most of the time sponsors will hire many advisors, and it will add to the cost of the project. Just to give you an idea, the development costs can reach up to 5 to 10% of the project costs. And that is why project finance cannot be used on small scale projects, because the costs on developing these projects are high, that it needs a minimum threshold or minimum amount by which each party starts to make money. So the finance deal must have a critical minimum size threshold below which the project will become more expensive, to its forecasted income and cash flows. This is our last slide, and then we will take some lectures because we are already crossing our time limit. So what happens then that once the project is developed, the joint development agreement is superseded. And this joint agreement is superseded by a shareholder agreement. And this shareholder agreement is established between the project company who has already been set up. And this company makes the contracts with the shareholders, which are the sponsors. And this defines many things and gives the rights to the shareholders over the project company. So what areas are covered in that shareholder agreement? What is the percentage of the share by each party? How they will inject their money? What is the procedure of subscribing their equity? So if the profits are generated, how they will be distributed? And if one sponsor in future wants to get out of the project or wants to sell some of his stake, how the sale of shares by the sponsors could be ensured? Who is going to manage the project company? Who will be a part of the board? And there are many decisions that will require the voting. And what are the voting rights of each party? And if there is any dispute, what is going to happen? So now, once this shareholder agreement is made with the project company, the shareholders have to inject equity in the project company. What happens now? Lenders would prefer that first sponsors inject their money and then lenders inject their money. So lenders prefer the equity to be invested into the project company through a subscription agreement. And this subscription agreement is made between the sponsors and the project company, which gives a security to the lenders that the equity is being injected in the project company. Now, this equity is the amount of money that sponsors are going to inject in the project company, comes through two ways. One is through share capital. The second is through shareholder loan. In share capital, it's quite simplified process. The company, once established, this company issues a certain number of shares, and those sponsors, based on the portion of the equity, they purchase those shares from the company. And then, since they have the shares of the company, they are entitled to any dividends or the profits generated by the company, and they are the owner of the company because they buy shares. The second way is this: they do not want to be the owner of the company, but rather they are willing to pay a loan to that company, just like the lenders are willing to pay a loan to the company. So that loan that shareholder makes to the company is a shareholder loan which helps to develop and operating the project. In that case, the company gives them typically the interest, as they give the interest to the lenders, and after the maturity, this money is returned back or this principal amount is returned on regular basis. But most common way in the project finance is to have a share capital to buy shares. And we have seen in majority of the cases, sponsors would like to be the owner of the project company and buy shares and inject their equity through shareholder.
So we have a couple of questions. I think we can accommodate 4 or 5 questions. And let me ask the first question. Our first question is from Junaid Hamid Saab, and he is saying his experience has shown the preparation of finance term sheet or financial commitment at the bank or lenders. Bank or lenders are directly affected and dependent on the project execution timeline and milestone. Kindly shed some light on this.
Yeah, definitely, because when the term sheet is drawn, one key concept is issued, and that is the availability of the fund. So in the term sheet, the availability of the fund is typically defined. And if the project extends beyond that time limit, sometimes it happens that there is a contingency being placed in the development cost that are being brought in, and sometimes there are some reserves that are being kept. But banks, in many cases, may ask sponsors to finance that additional cost. On the other hand, this is one of the risks that sponsors would like to pass on to the EPC contractor. Because if the contract goes late, there are a set of penalties defined in the contract, and those penalties had to be paid. But at the same time, the revenues of the project will be delayed. Because if I'm starting a project and I have to obtain a revenue in first month of the year, and because of the delay, it reaches up to 6 months. So my my commercial operation date is extended. So either client has to agree on this, or otherwise this has to be compensated by means of bringing in the contingencies. And these contingencies are a part of the financial model that are being kept.
Okay. Okay, great. Abdullah sir, there is another question from Muhammad Rafiq. And his question is, does the purchase of land come under project development phase?
Yeah, okay. So one of the beauty of this project finance is that risks are transferred to those companies who can best manage it. So purchase of land typically remains the responsibility of the client.
Okay.
So lenders,
Thank
as
you.
a part of their security, they would ensure that the land lease agreement or usufruct agreement is made, and lender ensure that this risk of acquiring the land is transferred to the client of the project.
Okay. Thank you, Abdullah sir. There is one question from Syed Alamdar Hussain. He want to know, how do you determine the appropriate debt to equity ratio for a project, and what factor influence these decisions?
Actually, this question is not simple to answer because we are discussing the
Running out of
basics.
time. Okay.
But one thing I would just say that debt to equity ratio has many factors to be defined. First of all, there are cover ratios that we will go in the later sections. Banks, they want to have a minimum cover of revenue and the payments. So if that cover ratio is not maintained, this is called debt to service cover ratio, DSCR. If this DSCR, banks, they have their limitations that if this DSCR is less than 1.15 or 1.2, they are not going to finance. So once they financially model the project, they ensure that all these ratios are maintained. And if these ratios are not maintained, then the banks will lower down their debt until unless these ratios are maintained. So this is a complex question, and I hope as we go in the advanced modules, we will be discussing this with some examples.
Okay, great. So I think we can address now last questions, which is from Mr. Junaid Hamid. He is saying, who makes preliminary information memorandum? If it has to be presented to the lenders, then ideally it should be sponsored representative or the bank lending department.
Now there are two ways to do it. If you are going to present it to one bank, then typically it is made by the development team of the sponsor. But if there are multiple parties engaged in this transaction, then this is a coordinated effort, because what happens that some preliminary information memorandum is being prepared by the development team of the sponsor. Then this is being given to the agent bank. Agent bank, based on his experience, manipulates or drafts more extensive memorandum, and that bank issues to the other banks to ensure that the money is being retained or obtained from that. So to this extent, initially, this is to be developed by the development team of the company. And extensively, if more banks are involved, normally this is the agent bank who works on behalf of those banks and who communicates with them by giving more details.
Thank you, Abdullah sir. I think with this we can close our session. And once again, we thank you, Abdullah sir, because you are traveling on business trips, still you fulfill your commitment and you spare time for your nice presentation. And it was really very useful. So as the series going on, so we are, I hope we are and other attendees are will feel more interested. So thank you very much for attendees for sparing the times, and you will receive the flyer for the next session, which will be, I think, after approximately 3 weeks. So we will announce on the LinkedIn and in our WhatsApp group. So thank you all. Thank you. Bye.
Okay, thank you. Thank you all.